Why should we be focusing on consumer price inflation? Well, for that answer, we turn to our chief equity strategist and economist, John Blank. John, this can get a little complicated. Let's take this step at a time. What's the official reason?
Yeah, so there's a dual mandate, what's called the dual mandate for full employment and stable prices. And actually, moderate long-term interest rates is really a triple mandate, but long-term moderate interest rates are tied to the stable price event. So it boils down to a dual mandate. So we have a high 3 household unemployment rate for almost 2 years now, and that means the first part of the mandate, full employment, is fully met and their Fed is very comfortable with. So it means the mandate of dealing with the second issue, stable prices, is all they're focused on at this point in time, and that is still above their target of 2% expected annual CPI, core CPI or core PCE rate. And the core PCE right now is in the low threes, and so we got another point and a half to chop off it.
And is that what all of the facts surrounding this are about?
Yeah, that's basically it. I mean, if you look at stable long-term interest rates, well, we get a 10-year at about 4.15%, which is basically 100 basis points above where the core PCE rate is now. That is a 1% real rate. So if you drop, the core PCE rate to 2.5, say by this year, you're going to get a 10-year down to the 3.6-ish, 50 basis points lower than it is now, and that's what everybody's betting on.
So it still can get a little confusing to the average person because there are a lot of moving parts in this one piece of information. There's the core and broad CPI timeline, the CPI for airline fares, the median CPI, the sticky CPI. Is there something that puts it all together for us to better understand it?
Yeah, I mean, basically you need to understand that CPI, consumer price inflation, gets put up by the Bureau of Labor Statistics. So it's a labor market. It's basically for Social Security and your payroll check and workers. That's why it's called the Bureau of Labor Statistics. The Fed runs the economy, so the economy-wide inflation rate is put up by the Bureau of Economic Analysis, BEA. And the BEA looks at economy-wide inflation, not consumer price inflation, economy-wide inflation, which is the core personal consumption expenditure. So that's the difference. One is a little more focused on what's pertinent to the worker, and the other is for the economy.
So what are the main conclusions then to be drawn from the data, especially regarding recession? And we can't forget that CPI data also came out recently for some of the global markets. So what story did that tell?
Yeah, I mean, basically, you got to understand we're coming off the back end of a supply shock, not a demand management event. And what that means is you just go back to your supply and demand chart in your macroeconomics textbooks. An increasing supply coming out of supply shock is going to have this thing that we are seeing, which is stronger growth and lower prices. So this has been, basically a big missell on the part of the economics community who thinks only about interest rates and demand management, when in fact what we've been doing is going through the classic, experience of unwinding a supply shock.
So we have to also ask about U.S. GDP growth. What's that looking like for this year?
Well, very tough to get anything below trend growth when you got a strong consumer, Terry, and that's what we had in 2023. Because consuming is spending, and spending is 70% of the story in the U.S. economy, and that supports the job market, which is still tight because of all the retirements during the COVID period. So it's very hard to see. There are shocks to the economy. There are, parts of the economy that are sectors, industries that are in recession, but the entire economy can be resilient to those events.
But I also see news of companies laying off workers lately. Where does the labor market condition stand right now?
Yeah, so there are a rising number of tech companies that are laying people off on the January, calendar year event, just like last year. But again, that's only in select companies and only in the tech sector. Yes, it's very important. Bears worth watching, but that is not actually the U.S. economy, particularly outside of a few concentrated cities.
So let's talk about the consumer that you alluded to a moment ago. December retail sales topped estimates. Do you think the consumer is going to continue their spending going forward?
Yes. Answer is yes, I do. I see no reason with a high, stable or a low stable unemployment rate. And high demand for workers, how they lose their incomes, it can tank the consumption rate. And it's just not going to happen, Terry.
Against this backdrop, is everything we've discussed here why investors should be upbeat about the U.S. economy?
Yeah, I mean, here's an interesting thing that's different about 2024 versus 2023. I think they should be upbeat on the U.S. economy, probably not as upbeat as 2023, but still upbeat. And I think they should factor in that the sentiment trading that took the market up into the 20 PE ratio on the forward look for the S&P 500 is probably overpriced. So we can get an event here, Terry, where we get a little bit of a correction in the next few months in the stock market, and that should not affect the underlying consumption growth rate in the U.S. economy. So this is going to be different than last year. Last year I was bullish early and saw a strong economy, which did materialize. This year I see, good economy trend, but I see actually some valuation headwinds for the stock market.
Could one negative be that the Treasury yield curve inversion recently took place? Could that portend a recession?
Absolutely, Terry. Absolutely. I think everybody needs to understand that we have not put to bed the recession risk for 2024. It is material, and it's probably higher than most people want to realize because you can get disorderly events from financial conditions, and that can cascade into a contagion, which then takes the economy down. And these aren't inevitable, but you cannot ignore them given the amount of speculation that happened during the COVID period and the combination with high rates, which have basically, put a lot of pressure on a lot of those speculative endeavors.
All right, stocks on the strong buy list include Martin Marietta Materials, Ryanair, and Cloudflare.
Yeah, ticker MLM is a number 2 ranked stock with a B for growth. I've got a share price of $4.94 staring back at me, Terry. That's too rich for me, and it's fully priced in, so I'm a seller of Martin Marietta. Ryanair, this stock's a $129 a share discount airline in Europe. Target price $151. It might get there. The surprise here is that Ryanair, has been, a European stock, and it may be the case that Europe turns out to have a better year than most people think. Cloudflare, really interesting stock here, ticker NET at $82 a share. This platform protects and accelerates any internet application online. So, and it was up to over 200, during the COVID pandemic. Great fundamental earnings story here and a nice momentum story. So you got to like Cloudflare right now would be my strong buy pick of the 3 we talked about today.
Our chief equity strategist and economist, John Blank, on the economy. With John, I'm Terry Ruffalo. Here's something you might want to check out. Zacks Ultimate gives you 30-day access to all of our buys and sells for only $1. Go to Zacks.com/promo for details.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.